Decentralized finance has lost over $5 billion to exploits, hacks, and protocol failures since 2020, making it one of the most fertile fields for institutional risk analysis in the history of finance. Despite this loss record, DeFi protocols generate genuine yield from real economic activity and have continued to attract institutional interest from sophisticated participants who believe the risk-adjusted returns justify engagement. The challenge for institutional allocators is that DeFi risk is structurally different from traditional financial risk. The risks are not primarily credit risk, market risk, or operational risk in their classical definitions, but rather a distinct taxonomy: smart contract code risk, oracle price manipulation risk, governance attack risk, and liquidity risk specific to automated market maker mechanisms. This analysis provides the institutional framework for evaluating each risk category systematically. The goal is not to avoid DeFi entirely, but to apply the same rigorous risk-adjusted thinking to DeFi allocations that sophisticated institutions apply to any other investment category, recognizing that the specific risks require specific evaluation methodologies developed for this novel asset class. Smart contract risk is the most fundamental category in DeFi risk analysis. Every DeFi protocol is a set of immutable, or upgradable, smart contracts that execute automatically based on code logic. When that code contains vulnerabilities, attackers can exploit them to extract funds that the protocol code was designed to protect. Unlike traditional software vulnerabilities, smart contract exploits are usually immediate and irreversible. Oracle risk represents a more sophisticated attack vector that has generated some of the largest DeFi losses. Price oracles are the data feeds that DeFi protocols use to determine asset prices for lending, liquidation, and collateral valuation. When an oracle is vulnerable to manipulation, an attacker can use flash loans to temporarily distort prices within a single transaction, triggering liquidations or borrowings at artificially favorable prices before the transaction reverses. Governance risk has emerged as a critical vector in mature DeFi protocols that have transitioned to decentralized governance. The Beanstalk exploit in April 2022 demonstrated the severity. An attacker used a flash loan to acquire temporary supermajority of governance tokens, passed a malicious governance proposal in the same transaction, and drained $182 million before the governance community could respond. Any protocol with governance token-weighted voting is theoretically vulnerable to this attack vector. The DeFi red flag framework allows institutional risk teams to efficiently filter the universe of DeFi opportunities to those meeting minimum institutional standards. The 4 red flags represent characteristics where the risk-reward balance is systematically unfavorable for institutional capital. Unaudited contracts offer yield that does not compensate for the probability-weighted loss from exploitation. Single oracle sources create predictable manipulation vectors. Anonymous teams remove accountability that serves as an important fraud deterrent. And governance token concentration creates governance attack surface. The absence of red flags does not guarantee safety. The largest DeFi exploits, including the $625 million Ronin bridge hack and the $320 million wormhole exploit, occurred in protocols that had passed initial institutional screening criteria. Smart contract risk cannot be fully eliminated, only managed through diversification, position sizing, and ongoing monitoring. The appropriate institutional response to this residual risk is not to avoid DeFi but to size positions so that any single protocol failure represents a manageable loss rather than a catastrophic one. A DeFi allocation framework that limits any individual protocol exposure to a small percentage of total DeFi allocation and total institutional assets under management converts the binary risk of protocol failure into a portfolio-level risk that can be modeled and managed. The institutional DeFi due diligence checklist translates the risk taxonomy into actionable evaluation steps that risk teams can execute consistently across protocol evaluations. The 4-step checklist is ordered by the most common institutional failure modes: accepting yield without verifying audit quality, misunderstanding oracle architecture, failing to assess governance concentration, and not reviewing historical incident response. Audit history review requires going beyond the presence of audits to evaluate their quality and completeness. A protocol with one audit from an unknown firm 2 years ago presents very different smart contract risk than a protocol with quarterly audits from 3 top-tier security firms and an active bug bounty program. The specific findings of each audit and the remediation actions taken are the most informative data points. Governance structure assessment can be conducted using on-chain analytics tools that provide detailed governance token distribution statistics. For protocols using token-weighted governance, the key metric is the minimum token holding required for a supermajority vote. If an attacker could acquire a supermajority through a flash loan or a single large purchase, the governance mechanism provides false security. Protocols with time lock controls on governance execution, where approved proposals have a mandatory delay before execution, provide substantially stronger governance security. The exploit record analysis reveals important patterns for institutional risk prioritization. Cross-chain bridge exploits represent the largest individual losses because bridges hold concentrated pooled liquidity that, if compromised, can be drained in a single transaction. Bridges represent an architectural concentration of smart contract risk that fundamentally differs from single-chain lending or AMM protocols. Governance exploits like Beanstalk demonstrate that protocol maturity and track record do not guarantee safety against novel attack vectors. Beanstalk had operated for 8 months without incident before the governance attack, and standard smart contract audits would not have identified the governance flash loan vector as a critical vulnerability because governance mechanism analysis requires different tools than code vulnerability analysis. The flash loan and Oracle manipulation exploits in protocols like Euler Finance are particularly instructive for institutional risk teams because they demonstrate that sophisticated attackers can identify and exploit complex multi-step vulnerabilities that require deep protocol knowledge to execute. The Euler Finance exploit involved 11 separate transactions and exploited a specific interaction between the donation mechanism and the liquidation system that created a vulnerability invisible to standard audit review. The DeFi expected return framework converts qualitative risk assessments into quantitative adjustments to gross yield that allow institutional allocators to make apples-to-apples comparisons between DeFi opportunities and traditional fixed income alternatives. The framework forces explicit assumptions about exploit probability and loss severity, rather than allowing implicit optimism to inflate expected return estimates. Exploit loss probability must be estimated for each protocol category. Bridge protocols have historically demonstrated the highest exploit rates. Single-chain lending protocols with multiple audits and long track records have demonstrated lower rates. These are not precise actuarial estimates but informed probability ranges that force explicit risk quantification. The comparison to traditional finance alternatives is the most important final step. A DeFi protocol offering 8% gross APY with a risk-adjusted yield of 5% after accounting for exploit probability is not obviously superior to investment-grade corporate bonds at 5% with substantially lower variance. The institutional case for DeFi yield must be made on a genuinely risk-adjusted basis rather than on gross yield comparisons that embed significant unacknowledged risks. The DeFi risk framework provides institutional teams with the structured methodology to engage with decentralized finance opportunities in a manner consistent with fiduciary responsibilities and institutional risk standards. The 5 principles represent the non-negotiable minimum standards that distinguish institutional engagement from speculative participation. Implementing the framework requires building specific capabilities that traditional institutional risk teams may not possess: smart contract audit reading, on-chain analytics for governance distribution analysis, and Oracle architecture assessment. These capabilities can be developed through specialist hires, external advisors, or partnerships with crypto-native risk analytics firms. The institutions that build genuine DeFi risk assessment capabilities are better positioned to access the yield opportunities that DeFi provides on a risk-adjusted basis that is genuinely competitive with traditional fixed income alternatives. The institutions that engage with DeFi without these capabilities are accepting risks they cannot quantify, which is inconsistent with institutional governance standards regardless of the headline yield opportunity.